We have got the potential for waking up one morning and suddenly realizing that something has gone horribly wrong. We'll see that pressure for interest rates begin to rise. That will prick the equity bubble. Once that starts collapsing, they will increase the level of QE to try and save the economy, is the way to put it, but actually save the stock market. It won't work.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs. Welcome back to Liberty and Finance. We have a returning guest that our viewers are always delighted to see. This is Alasdair MacLeod. He is the head of research at GoldMoney.com, and he joins us this Wednesday, July 14th, 2021. Alasdair, as always, thanks for joining us here again on Liberty and Finance.
That's my pleasure, DK.
Our viewers have been generous at submitting questions ahead of your arrival. Fully 2/3 of those questions deal with the topic of Basel III. We need to deal with it. In fact, that's what I emailed you about when we scheduled this interview, was an article that came out saying that there had been an exception carved out from the regulations that were going to impact the LBMA and so on. We really would appreciate, and our viewers in very large part would appreciate your update on the insight into two things. One, how important or significant is this exception that was created? But the bigger picture is, how important will, in your updated view, Basel III regulations be to the way that bullion pricing is established on these major exchanges? So could we take those, first of all, the exception and then the impact?
Basically, what it means is that if you're one of the four owners of the London Precious Metals Clearing Limited, which is the settlement engine for all the LBMA trades, then you don't have to put up with the net stable funding requirement, net stable funding ratio. You don't have to apply it. In other words, basically what happens with the settlement engine is that you've got all the people with long positions to settle and all the people with short positions to settle. And basically, when they settle, there's no position left over. So every day, all these positions basically marry in together. The only exception are positions which stand for delivery. So in this sense, it's quite like COMEX, I suppose. So really what the LPMCL works as is a sort of central settlement authority. And this particular rule allows that to continue. Now, this is very important because we're only talking about settling these trades in this, if you like, central counterparty operation. So that is very important to understand. It doesn't affect anything else. Now, as far as the other banking members of the LBMA are concerned, they can also avoid the strictures of the net stable funding ratio by running their business in such a way that where they have customer obligations, in other words, gold accounts or silver accounts or platinum or palladium accounts for their customers, they have to match the liabilities to those customers exactly with physical bullion. So in other words, the derivative market that we have in London, which is forwards, these are derivatives, will be replaced, so far as we can see, with physical backing. Now, this is very important because at the moment, the LBMA claims that it's dealing in gold. It's not. It's dealing in gold derivatives, paper gold. It's as simple as that. So on that basis, what's happened is that the banks in London, member banks of the LBMA, will have to acquire physical gold in order to continue to offer a service to its customers who want to have gold accounts or silver accounts or platinum group metal accounts. So those are the two important changes. Now, when it comes to assessing the quantity of outstanding forwards, we don't get this information from the LBMA. We have to go for the Bank of International Settlements, who, interestingly, confirm my reading of forwards, and that is that these are derivatives. These are over-the-counter derivatives. And if you look at the figures there, that's the equivalent of about 8,700 tons of gold is the outstanding position on forwards and swaps. Now, the bulk of these are forwards. So the forwards, 8,700 tons of forwards and swaps are going to disappear, but they're going to be replaced by physical to a greater or lesser degree. Now, I don't know. I would think that quite a lot of traders in London who take advantage of a system where basically you buy and sell, and the costs of doing it are virtually zero, might actually drop out of this equation. But there are bound to be quite a few people who have accounts with banks who look at them as protection against declining fiat currencies, whether it's euros, dollars, sterling, whatever it might be. Those people are going to, as far as I can see, are going to have to move over from an unallocated account not backed by anything. The banks are going to have to provide them, if you like, a pooled account is probably the best way to describe it, backed by physical. It's either that or these people actually go to these banks and say, can you act as a custodian for us? Now, in terms of expense, if you're a very large fund, the rate at which you can get a custody deal in London is in the order of 8 to 10 basis points. Now, this compares with ETFs, which charge you, you've got all the structure charges and all the rest of it. And ETFs, you're looking at, 1% or something, or even more. So this is a very efficient way, if you like, for an institution to hold gold. So it could be that this broadens the interests, if you like, of investing institutions when it comes to investing in gold and silver. But we'll just have to see how that pans out. There is a bit of a question mark over the status of derivatives under this new legislation. I've just had a note from the LBMA, and they are interpreting this as an RSF, the required stable funding, of only 5%. Now, this compares with physical gold of 85%. This doesn't make much sense to me. It only makes sense in if, let's say, you assume that because the derivatives are so huge in terms of, what a bank actually takes on. Derivatives are for leverage. Then, if you say it's 20 times leverage, then that's 100%, the equivalent of 100% RSF. But this doesn't make an awful lot of sense to me. There is another category of derivative, which looks to me as if it's 100%. So there is if you like, a question of interpretation on this new draft rule book. So that position needs clarifying. But subject to that, it looks to me as if the day of forward contracts being the norm in dealing in London basically is over. I think that what the Bank of England would like to see is this market becoming more of a physical market. And interestingly, ICBC Standard Bank, which is, it's the London subsidiary of that, the biggest bank in the world, the Chinese bank. They bought back in, I think it was 2016, they bought vaulting capacity. They acquired Barclays Bank's for almost brand new vaulting capacity, which takes up to 2,000 tons of gold. And just before that, they took out a lease on Deutsche Bank's vaulting facilities. So Now, this is interesting because they will have seen the Basel regulations because they were finalized way back in 2014, October 2014. So the Chinese would have seen this and they would have seen it coming. And so from their point of view, they can see that this is going to move from being predominantly a paper gold market into becoming more of a physical gold market. So this is interesting. And as far as the Bank of England is concerned, they will be looking at the whole situation from top down and presumably in consultation with the Treasury as well, seeing that, okay, London is the center of paper gold, derivative gold. Shanghai has become the center of physical gold dealing. So, do they want to just give up the whole thing, or do they want to make arrangements whereby London can continue to have, if you like, the preeminent position in terms of dealing in gold in the West? And I think that is behind these regulations.
Now, a lot of our viewers are trying to get to the kernel of the nut that they're looking for is this narrative which has been advanced over the past, I don't know, at least decade, maybe several decades, has been that with almost unlimited ability of paper future sellers or short sellers to dump more than the world's production of gold or silver onto the market, they can basically at especially thinly traded periods of time cause the price to move down remarkably, and then later on close those positions out during heavier trading times when the impact is not as extreme on the price, and therefore not only manipulate the spot price, but also make an insane amount of profit along the way. And as long as the regulators look the other way, this has been a good work if you can get it. Does anything that you've just summarized about this daily clearing and matching the books function being the only thing that's the exception, do anything to dispel concern that, we're going to be right back to business as usual with this dumping of futures and moving the spot price, and that help us just get to that understanding?
Yeah. I think those days are broadly over because if you put yourself in the shoes of the Exchange Stabilization Fund, which was originally set up in 1934 to do just as you described, they can use either a stock of gold, which the US Treasury has or did have, or alternatively they can use paper gold. Now, the point about using paper gold, if you're going to walk in, and they would tend to do this, I think, less in London, but more on COMEX. And we saw this actually going back a few years. They would dump sort of 5,000, 10,000 contracts, like that. And it was done in such a way that it was obviously deliberately done to drive the price of gold down.
Meaning it was done at a thinly traded time, and when there wasn't enough, it would blow through all the existing bids or whatever.
Yeah. I mean, and the nonsense in it all, which sort of rather suggests that it was done with that purpose rather than, a very large hedge fund taking profits or whatever, was it was so sort of public, whereas if you look at the other side of the equation, if you want to accumulate gold, what you do is you do it very quietly on the dips. You don't advertise what you're doing. So if you are advertising, then there is a political motive. And I think that did happen. The problem now is that paper markets are going to get thin. It will be very difficult for the Exchange Stabilization Fund, if that's who does it still, to go into the market, dump huge quantities of paper gold on the market. I mean, it would drive the price down more because there'd be greater volatility, but they wouldn't be able to close their position. So you can see that I think the days of that game broadly are over. And the other thing is that in this environment where you've got greater monetary inflation, and it's now sort of coming through into price inflation, you can see that the demand for gold from central banks around the world is getting beyond any control, if you like, of the US government or whoever might be, wanting to drive the price down. And I mean, even today, we saw, I think Brazil has acquired 41 tons of gold, added 41 tons to its reserve. So, central banks are in there. It's been very interesting watching the price recently, because over the last 2 weeks, it's been oscillating round about 1800. Every time it dips below 1800, what happens? Buyers step in. Now, we don't know who the buyers are, but you can, I think, take a reasonable stab at it and say, well, these are serious accumulators of gold, of gold. And they're in the market buying dips, getting what they can without chasing the price up, because the one thing you don't do is chase the price up against yourself if you're a serious buyer. And we've just seen that in the market. And it so happens that today, as we're recording this, it's sort of begun to move away from that 1800 level, and we're up towards, a little bit over 1820. So, it could be that, if you like, all the sort of the overhang at that sort of 1810 level has now more or less been cleared out, and we could have a little bit of a run. I don't know. We'll see. But I think getting back to the point that you were asking about, I think the days when the sort of the major central banks, and particularly the Fed, the US Treasury, and also the Bank of International Settlements, trying to, if you like, keep the gold price under some sort of wraps. I think those days are beginning to disappear.
Now, we'd like to also look at inflation with you. It's been a very important topic for the last year here, especially. We've had, as you know, John Williams from shadowstats.com on. You've talked about the Chapwood Index, all these indicators that we're saying basically for a long time, for years actually, but especially over this last year, that in fact the real impact of price inflation was running closer to 6 to 10%. Now John Williams is saying 12 to 13% annually, as opposed to official numbers of almost negligible to 1 point whatever percent from the Fed. And yet recently the whole story seems to be changing, and as it's changed, it's the camps of people who are claiming different things about inflation are just bewildering to ordinary people. You've got officials now coming out and saying, well, actually, we're having transitory hyperinflation, but it's just going to be a blip as we come out of the COVID situation because of supply chain shortages in lumber and stuff. That's all going to resolve itself. Done. We'll be back to normal. You've got other people saying, actually, because of energy peak declines and stuff, we're going to have protracted deflation. You've got other people saying, no, we're off to the races. We have launched. We are in this past the point of no return. A snowball is going to build and the momentum is going to increase. Okay, I'm not asking you to be perfectly right, but could you just clarify your perspective on inflation or not now and going forward for the benefit of our viewers?
Well, it's very, very simple. All your viewers will know that money has been printed in huge, great quantities at an accelerated pace for some years now, and particularly in the last year. I mean, it was March 2020 when the Fed turned around and reduced interest rates to zero and announced QE, which is printing money in effect. Printing money aimed at pension funds and insurance companies, the rate of 120 billion a month.
Minimum and ongoing, yes.
Yeah. So and there were various other measures, all sort of designed to try and keep bond yields down. So, it was Milton Friedman who said, it was only sort of half his quote, that inflation anywhere and everywhere is a monetary phenomenon. And that's true. I mean, if you're going to print money, then there is going to be a price effect. And the first thing that happened was that we saw that commodity prices started taking off. And, each commodity has its own story to tell. I mean, you could say about things like lumber. Well, everybody was sort of ordering extensions to their houses and, new build homes were selling like hotcakes and all the rest of it. So there's a shortage of lumber. So that's why the price went up. Yeah, okay, fine. You could say things like microprocessors, there's shipping problems, logistics, whatever. So the prices were going up. Yeah, sure, absolutely. But when they all go up, there's only one thing driving it, and that is an increase in the quantity of money in the economy. And so that is the root of inflation. Now, the idea that all of a sudden it's going to disappear because it's transitory and, it'll sort itself out or whatever. I mean, it's complete rubbish. It's happening because they've printed money. It's actually as simple as that. So you don't actually need to know any more than that. What I can tell you is that it is impossible to measure the general level of prices, which is what the CPI purports to do. This is why you can come up with a number of answers. It's a statistician's delight. You can tell anything with statistics except the truth. So, here we have the situation where, on the one hand, you've got, the government claiming that inflation, according to the CPI, is running at 2.5% or whatever figure they pluck out of the air. It's a gold sort number, let's face it. And at the same time, John Williams, using the government methods of 40 years ago, quite clearly demonstrating a rate which is sort of 11, 12, 13%. And John Williams is a pretty serious guy. He does know what he's talking about. Which rate's right? It actually doesn't matter. The point is that money has been printed in huge, great quantities, and it has an effect on prices. It's never an even effect, but the combination of events as a result of COVID have just sort of accentuated the whole problem. The idea that inflation is going to stop at, say, 3, 4, 5%. When I say inflation, I mean price inflation, an increase in the general level of prices, is a load of nonsense, because you can see how much the acceleration of money printing has happened, and it's that's feeding into it. So the one thing we do know is that the other way of describing, if you like, an increase in the general level of prices, and this is the more accurate way of describing it, is the purchasing power of a currency is declining. So, we're now looking at a situation where the purchasing power of the dollar is declining at, 5%, 6%. John Williams says 13%. I wouldn't argue with him. Certainly if you look at the things that we commonly buy as opposed to the things we don't commonly buy, I suspect that John Williams is spot on. And particularly because the Chapwood Index, before they stopped doing it because of this COVID thing. They couldn't collect the statistics. But they were confirming, the top 500 items that you and I buy in around 50 cities in the United States, they were going up more than 10%. And that was last recorded. If they did it now, I think they'd probably say it's higher. So this is actually a very serious thing. And it's particularly serious because you've got an awful lot of foreigners who own dollars. And as soon as they wake up to the fact that they're being sold a pup about the inflation statistics, then they're going to want to reduce their exposure to the dollar. And they probably don't need to have half as many dollars as they've got. The current level, according to the Treasury tick figures, including bank balances, is in the region of about $32 trillion, which is 1.5 times US GDP. Just imagine that. Foreign ownership of financial assets in America, 1.5 times its GDP. Is this not overinvested or what? It really is. The foreigners are going to start selling unless interest rates go up. But the problem is that when interest rates go up, what happens? The equity market bubble pops. And this is why I've always sort of said this is a John Law repeat, if you like. And what I mean by that is that John Law, back 301 years ago now, printed money basically to ramp up his share prices. And eventually, when that printing of money failed to sustain his bubble, the Mississippi bubble, it took the currency down. The currency collapsed to nothing. The Mississippi venture still had some value at the end of that process, but the currency went to zero, absolute zero. And what's happening now? Major central banks led by the Fed are doing exactly the same thing. This 120 billion a month QE is going straight into bonds and equities. Why? Because it is being given in return for US treasuries, low yielding US treasuries, is being given to pension funds, investing pension funds, and insurance companies. And they're putting it into the market. That's the source of the bubble. I mean, if it wasn't for that, share prices would have collapsed by now. I mean, they'd already started collapsing rather like a 1929 collapse in January last year, which by March, the S&P had lost a third of its value. But, it's easy to forget these things. Since then, it's virtually doubled. So, the bubble is still going. But it's actually, I think if you go back to that time last year, the very beginning of the year, I mean, it was really beginning to look like 1929. The difference being that the dollar was not tied to gold, which meant that prices went, all prices went down, financial assets and everything else. This time, they're printing money. Firstly, to sustain prices, and then secondly, to just keep the show on the road. And where this goes is the next level of QE is not going to be a reduction. It's going to be an increase to keep the bubble going. And, I wouldn't be surprised to see 200 billion a month. I wouldn't be surprised to see $250 billion a month to keep the bubble going. You've got to ask yourself, what does that do to the dollar? It kills it.
I want to get into that about the dollar collapse, but before we leave this topic of expansion of the currency supply, and I'm going to try to discipline myself to say currency instead of money, the specter has raised its head in the last week here. Well, you've mentioned it several times in the past about the banks will eventually draw in their horns if they don't like the risk environment. The retail investors are being forced into the risk environment. Some of these retirement funds are being forced into the risk environment because it's the only place they can find a yield these days is by going into the equity markets, that sort of thing. But just this week, we had an announcement from Wells Fargo that they're getting out of the personal line of credit business entirely. They're closing existing ones. They're not going to open any new ones. And we've started to discuss that. Are we on the foothills of what you've been warning us will be coming, and that is banks drawing in their horns? Because when you talked about the expansion of the currency supply necessarily driving, eventually it'll show itself up in price inflation. But we've had, Jim Rickards and others talking about not if you don't have velocity of money. So if the lenders are starting to hoard and just say, forget it, I'll just keep it on file with the Fed and I'll get my, whatever it is, fraction of a percent instead of what I could get on the open market. Are you seeing what you see as the beginning of contraction of the willingness to lend on the part of banks? Or are we overinterpreting these announcements?
I think as far as Wells Fargo, we're probably over-interpreting it. I mean, I think that, the problem is that it's rather like a situation where, a bank is perhaps not all it should be. And you get rather nervous on any announcement and you always read into it, this must be bad news sort of thing. But I don't know the specifics about Wells Fargo. I mean, I looked at the balance sheet and I would say it's not the most geared US bank by any means. We know that the management of the bank have made some pretty bad errors in the past, on the marketing side, sort of offering people money who didn't want it, making up accounts and all. I mean, there was all that sort of stuff. And the way this has been presented, and I don't know that it is otherwise, is that it's the knock-on, regulatory response to all those problems. Sounds a bit odd to me, I must admit. But I think what I would rather do is to talk about the trend of bank lending as a whole, which has been moving away from financing non-financial entities, providing bank credit for non-financial entities. It's been moving away from that really for the last 40 years to providing finance for financial activities. And if you look at the bank's records of loans and leases, it's actually been declining. In other words, they have been removing bank credit on a total basis from the non-financial economy. And they've been doing that now, I suppose, since about, a bit over a year now.
Would non-financial economy include residential mortgage borrowers, small business loans, that sort of thing?
Yeah, exactly. And,
so people.
People.
We're not lending any money to people anymore, only to other banks.
Main Street as opposed to Wall Street, if you like. Yeah, absolutely. So, I mean, the withdrawal of that has not been huge, but the trend is very definitely there. I mean, basically what they're saying is we want to recover our loans, from non-financial activities at the margin rather than add to them. And this, of course, is not doing the economy any good. To some extent, it reflects an underlying trend, and that is what President Trump picked up on, and that is that all the manufacturing which used to happen in America no longer happens in America, it happens abroad. So in a sense, you could say that there is less need for the banks to lend into the non-financial economy. But it's a chicken and the egg argument, really.
Absolutely. I mean, for goodness sakes, after all, you're a non-productive economy, so we're not going to let you invest in any productive growth anymore. Yeah.
Yeah, absolutely. So, but I think that's what I would look at rather than Wells Fargo. I just think that, I mean, the banks have the problem, and this could be behind Wells Fargo's trouble. The banks have the problem that effectively they've run out of balance sheet. I mean, they don't have much capacity to lend. And, one of the problems with expanding your lending into financial activities is that the margins are a lot smaller than they are, in a normal credit cycle when you're lending to business. Because when interest rates were a sensible level, say, a Fed funds rate of, say, 6% or something like that, a bank could lend to a manufacturer or a service industry, non-financial service industry, could lend at, say, 8%. Yeah? What's the cost of that? I can tell you, zero, absolutely zero, because they create it out of thin air. While you have got the loan, let us say, of $1 million going out on the asset side of the bank's balance sheet, on the liabilities side of the balance sheet, at the same time, through the miracle of double entry bookkeeping, it creates a deposit of $1 million. Now, you don't necessarily see that as the borrower on your account, but that is the reality of bank lending. The cost of this, loan at 8% is 0%. That is the beauty, as far as the bank is concerned, of creating bank credit. Now we've got a situation where interest rates are zero. I mean, there's no money in it anymore. So what do? You go out and you punt the market instead. I mean, it's far easier now to make money, running a book in equities or running, a book in paper derivatives of some sort, whether it's gold or whether it's credit default swaps, doesn't really matter. You just do huge turnover in that sort of stuff. Also, the other thing you get is because you can't make any money out of lending to business, you charge huge great fees to get companies listed, whether it's equity or bonds or whatever. I mean, so the corporate finance income, it replaces an awful lot of what you've lost in the normal line of banking. So the whole character of banking has changed completely. And I saw there was a thing on Zero Hedge about Goldman Sachs apparently have aggressively reduced their equity position. I mean, you could sort of think, well, let's sort of be a bit conspiratorial about it. They obviously think the market's going to fall. Not necessarily. They could be complying with the new Basel regulations because there is a cost to holding equities on your balance sheet through this net stable funding ratio calculation. And if you look at Goldman Sachs doesn't have huge amounts of retail deposits. They have large corporate deposits. Those are penalized under the available stable funding calculation applied to the liabilities side of their balance sheet. So, they'd probably rather they weren't a bank at this stage.
Something smells rotten about this whole thing in terms of our entire economy being stagnant, locked down, fallow, people out of work, people unwilling to work. My wife and I have a favorite place we like to go in Amish country in central Ohio. the restaurant is down, shut down, even though this is their peak, potentially their peak season is summer, because they can't get workers. So you've got this idea of small businesses having been shuttered, people out of work. So you talked about this non-productive. The banks are not willing to invest in the ordinary business economy and individual credit lines because it's seen as non-productive and risky. But meanwhile, they're investing, you're saying, in things that are non-productive too. So it's like the whole picture just sounds like a cessation of productivity.
Yeah, that's a pretty good way of describing it. And meanwhile, the central bank, your central bank, your Fed, is saying, "Oh, don't worry. Well, people have got strong balance sheets. It's looking at, it's all looking all right, but it needs a little more stimulation." I mean, honestly, they're talking absolute rubbish. Either they don't know what they're talking about, or they're spinning a yarn, and I'm not going to try and decide which it is.
So now I'll go ahead and let you get into the dollar collapse, because that's a question that's been asked by Creo, the lone traveler, who says, "Alasdair, I heard a very wise man say that when the dollar collapses, the government will collapse right after. What's your view on this perspective?" So that's one specific question within the scenario of a dollar collapse. You've just talked to us about properly or accurately described inflation is the destruction of the purchasing power of a currency. So can you talk to us about what signposts you have most recently seen since we met with you about a month ago about the U.S. dollar, perhaps as the poster child there?
Yeah. Well, I think the politics of a dollar collapse. I think your correspondent has got a very, very good point, because when you get a collapse in the purchasing power of a currency, there are obviously huge political ramifications. It depends how far it goes. But I mean, we've seen other countries, rather than major countries recently, where their currencies have gone down and down and down in terms of purchasing power. I mean, let's not talk about Venezuela. You've got enough examples in Latin America. You've also got Turkey. And you get a lot of political disruption. You get, people are hungry and all the rest of it because they can't afford food. Effectively, they are being taxed on their earnings. And it's something that, initially they don't understand. But then when it hurts, they really do begin to understand.
So again, devaluation of the currency taxes every earner because it makes your earnings mean less. Savers because your savings will buy you less. Retirees because your retirement income stream.
They end up starving. Yeah, absolutely. It is a very, very serious thing. And I would say, in my view, because of the comparison that I've made with the John Law situation, I mean, it is such a parallel actually through 3 centuries of history. It's such a parallel. That I can't see any way in which the dollar is not going to collapse its purchasing power. It's not like the deliberate destruction of the purchasing power of the currency through overprinting. I mean, I think we need to get that story, push that to one side. It's not like how Germany was sort of envisaged between 1918-19 and 1923, when the paper mark finally became worthless. There was a lot of deliberate raising of money through money printing involved in that. It wasn't entirely why it collapsed. It collapsed because people began to lose faith in the currency, and it was that really took it down to zero. I think it's not quite that situation nowadays. What we have instead is we have got the potential for just waking up one morning and suddenly realizing that something has gone horribly wrong. And the way it will have gone wrong is you will find that interest rates start rising despite what the Fed is doing. And going through the steps by step, they're at the stage of, denying that these dynamics are happening. That's what effectively Jay Powell has been telling your Congress today. I think he's been on today. The next stage is that you will find that the purchasing power of the dollar, it begins to be reflected in the foreign exchange markets. Now, that's a pretty obvious thing. It's very visible. But another way to look at it is purchasing power against commodities. And if they start rising in price, which is the same thing, again, you will see that, hold on, we're having another shift downwards in the purchasing power of the dollar. Pressure for interest rates to rise will then increase, and it will increase because the foreigners will be bailing out. And this is why it's so important to understand the extent to which they actually own the dollar. And when they start bailing out, I think at that stage there will be absolutely nothing the Fed can do. But they don't have a mandate to just say, sorry, we've got to stand back. We cannot handle this. Anything we do is just going to make it worse. We just have to let everybody sort themselves out. They don't have a mandate to do that. They've got a mandate to interfere. That is their job. So what they will do, I think quite simply, is they will, as I said earlier, they will increase the rate of money printing to try and stop financial assets sliding in value. And the path on this is emerging actually to be quite clear. So the first thing we look at is we'll see that pressure for interest rates begin to rise. That will prick the equity bubble. Once that starts collapsing, they will increase the level of QE to try and save the economy, is the way to put it, but actually save the stock market. It won't work. It won't work. The foreigners have got $11 trillion worth of US equities in portfolios. Now, the only reason they own these things is because they find they're profitable. The moment they're not profitable, they're gone. And that's 11 trillion that's got to be absorbed. On top of that, if you look at the level of borrowing, investors borrowing to gear up their positions in the market, according to FINRA, the level of investor borrowing at the moment is around about $900 billion. Now, at before the Lehman collapse, it hit a then record of around about $200 billion. We're 4 times that now. Now, if that's not an indication of the madness of crowds, I really don't know what is. So we've got a market which is so hyped up, it is ready to actually take an enormous fall. A fall which the initial reaction from the Fed, as I say, they'll say, we cannot afford to see these markets go down. I mean, just think what happens to government funding if bond yields start rising and all the rest of it. They will come under pressure, whether they like it or not, to save the markets, and they will do that by printing money.
The scenario of how that then plays out is sobering. In not just in financial terms, but in life terms for so many people. We've had a taste in the past year, most of us around the world, of what civil unrest or lockdowns and that sort of thing can bring. We wanted to get a quick check-in with you. You're in the UK. That's a different jurisdiction from most of our viewers in the US. We have quite a few in the UK, by the way. Thanks to all of you who are watching from there. But we really want to understand about preparedness and the reality of lockdown. So 2 questions. One is mine to you about what is the current state of affairs in lockdowns in the UK. We've certainly heard reports from Canada that it's just grinding on, and the 4th go round again, and Australia, new more severe restrictions. So that's number 1. And number 2 will be what do we think that the preparedness aspects of that are? And we actually have a very personal question for you from one of our viewers about preparedness. But let's just talk first about what's the reality of the lockdown situation in the UK and as from your experience.
Okay, well, the first thing is that the government are determined, and it's going to go ahead, that all laws concerning lockdown will end on this coming Monday. But if you think that suddenly is, hey, freedom, no. You will find that you go into pubs, restaurants, whatever, you probably have to wear a mask. If you're going to travel on public transport, you will have to wear a mask. This is freedom in name only. It's not reality.
I got to take, on that note, we got this flyer in the mail. Says it's called Celebrate Your Freedom. Look at that. There's a happy couple, and it says Celebrate Your Freedom, and it goes down this list of you're free to not wear a mask, you're free to not social distance, you're free to do all this stuff. If you're fully vaccinated, then you can just be totally free. So ironically, it's a very controversial topic, at least in the U.S., and I imagine so worldwide, is that people saying, what if I choose out of my freedom? What if I freely choose not to take an experimental vaccine, No, that we've rebranded freedom is when you comply. So go ahead. Sorry, I couldn't help that.
Yeah. So anyway, it's freedom in name only, really. The problem that government has, and this we've seen this not just in this case, but in almost every incident throughout government history, that when they take freedom away from people, they find it almost impossible to hand it back. And so what we're getting is freedom with conditions, if you like, and that's what it boils down to. So the scientists over here are warning us that this new Delta variant, once the restrictions come off, it's just going to rocket up. I mean, already the rates of infection are rocketing up. The one thing that's not happening is we're not getting the deaths, and we're not getting the deaths because of the level of vaccination. And on that, the British government have actually been very, very successful in terms of rolling out the program of vaccination. I think a lot more successful than almost anyone else in the world, other than America. America's done very well as well, as I understand it, in terms of vaccinations. So, the answer to this really is that I think that this is going to be a rolling problem still. I don't see businesses being able to reopen and suddenly it's all going to be tickety-boo. I don't see that happening, really, this side of the winter. And, of course, as we get into the winter, you've then got all the seasonal pressures. I mean, and a lot of this is not to do with us as individuals. It's protecting a government department called the National Health System. So, what they want to do is to ensure that the National Health System, the government, health service, can actually cope and is not overloaded with people with COVID or whatever. And that actually is what it is all about from the government aspect. They don't actually care too much whether you or I die. It's a question of whether the government department, for which they've got responsibility, can cope with the situation. And, if the choice is to put in funds and help it to cope, they'll go through the motions of doing that. But basically, no, I mean, they want to protect their system themselves as much as they are protecting you and I. So I'm perhaps a little cynical about it, but I really see around the world the same story being pushed out by the scientific community, that there is going to be a new resurgence of infections, and it'll affect the youngsters and all the rest of it. We won't get the deaths quite so much because of vaccination. In some countries we will, obviously, where vaccination has been relatively low. But the idea that this is sort of now over, no, I'm afraid not. I mean, I've just booked a holiday for next year, and I'm rather hoping that I'm going to be able to go or be allowed to go.
Yeah, we canceled three vacations we canceled in the past year, as well as 3 conferences got canceled on us. Related question from Pau Emanteg, who says, are you prepping? If so, what are you doing? A list of what you have done and what you intend to do would be helpful to see your commitment at this stage. It's a very personal question. Is there anything you're comfortable sharing about any preparedness? You already mentioned to us at times we've had trouble with internet connections, that you live out in the country a bit more than in the city. That's one thing that's to an advantage, I think, of people being able to have access to local grocery growers, that sort of thing. But anything else from a preparedness standpoint that you've either have done or contemplating?
Well, I grow my own vegetables, I suppose, but not very well, I have to say. and I end up paying a gardener to doing most of it. Anyway, so there's that. I run my life on the basis that gold is money, silver is money as well, I basically remove my dependence on currency, as you insist on calling it. Understandably, I'm with you on that, but it just seems to me, I'm not going to go into specifics, but what I would recommend is that you've got to have some physical bullion. Now, whether you have it just bullion or whether you have some coins which you have access to, And there's also a security problem here, which is why this is not a question which I can really answer. I'm not going to answer about my own situation, and I'm not going to advise other people, other than say you've got to be really careful. I mean, if you're going to try and store huge amounts of money in gold coins in your home, you've got to be very careful that nobody knows that you have done that, because when things are really nasty, you will get visits from nasty people. And that is something that you don't want to do. I mean, it doesn't matter where you live. If you live in the hills of Dakota or something, you're still going to get visits from nasty people. So I think the other thing I would say is that, be aware that this isn't just your problem, it's a community problem. And I think you've got to try and think of ways in which you can help your community. And your immediate community is obviously your immediate family and your friends and neighbors. I mean, particularly your friends rather than your neighbors. They may not be the same thing. But, it's going to come back, I think, to, if we see almost complete destruction of money, it's going to be a community thing, a community problem. And I think you've got to be prepared to help your local community. And I think that's desperately important. The idea of prepping and sort of running away and sort of, finding a bolt hole somewhere or whatever, it certainly has its attractions, but I think that's ducking responsibilities. And I would rather see people taking a more proactive view to helping their community, if you like, through the difficulties that we're likely to face. It doesn't really help your
No, it gets us thinking down the right channels, though, which I hope is the real intent of the question. So thank you very much for that. We've been speaking with Alasdair MacLeod. He is the head of research at goldmoney.com. Alasdair, people who want to find your weekly writings will do well to go where?
GoldMoney.com. I published an article on Thursday afternoon, EST, or late morning, and I do a market report on the Friday. So that's every week, Thursday for the main article, and then a market report on the Friday.
And folks, so that you don't miss a single episode with Alasdair or any of our guests or any of the links that they provide, make sure you sign up for our free newsletter. Just go to libertyandfinance.com. That's libertyandfinance.com. Right there on the homepage, you'll see where you can put your name, email address, click submit. You have to confirm to opt in. When you get an email confirmation, then you're in. It's all free. You get every single episode that we produce with any of our guests and any links that they provide. It's free. There's over 57,000 of us here on YouTube watching these videos together, and yet only 2,000 have taken advantage of this all free. Sign up for our newsletter. Alasdair, on behalf of all of our viewers, I thank you again for joining us here again on Liberty and Finance.
That was very much my pleasure, DK.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded. For physical delivery, vault storage, or precious metals IRAs, excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs.